Hey there, it's Tom Ryan, founder and CEO of ICR. Before we get into the next episode, I wanted to ask that you subscribe to the show. It'll help us get even more unique and interesting guests on the podcast and in turn continue to educate management teams and the growing ecosystem that creates value for fast-growing private and public companies. And while you're at it, head over to Apple Podcasts and leave us a 5-star rating. Very much appreciated.
If everybody knew what I knew, and if everybody had done 1,000 hours of research, and if Bitcoin wasn't volatile, everybody in the world who you hate, who has more money than you, who's more arrogant than you, would basically own all the Bitcoin. It would be $10 million a coin, and you couldn't have any.
No risk, no reward. That's especially true if you're willing to work harder, learn faster, and spot the opportunities others overlook. Success comes to those who make smart bets on things they take time to fully understand.
Teaching your kids don't play with fire. I mean, fire is what separates us from the apes. The only reason we're human is because we play with fire.
Being a public company can be hard. Small missteps can have outsized consequences. I'm Tom Ryan, founder and CEO of ICR, and over the last 25 years, we've helped thousands of companies understand and navigate the stock market and the media. We'll demystify these and other increasingly complex stakeholder groups so you can focus on what you do best, building your company and unlocking your true potential. This is Welcome to the Arena from ICR. Our guest today needs no introduction, but I'll give him one anyway. His name is Michael Saylor. He is the executive chairman and co-founder of MicroStrategy, a company that has adopted the Bitcoin standard as of 2020 and has been the model of value creation for the entire stock market for the last 4 years. He's probably the world's leading advocate for Bitcoin as a digital store of value, and today's conversation feels very timely, not only because Michael will be the keynote speaker at our 27th annual conference in Orlando this January, but because it seems to me that as of November 6th, the world has really woken up to Bitcoin's potential, and digital capital will almost certainly be a headline topic throughout 2025. So let's enter the arena with Michael Saylor. Bitcoin is such a huge idea. I know you started as a denier and then a skeptic and then a trader and then an investor and then a maximalist. What did you read? How did you do your due diligence?
You can learn anything on the internet. So, I remember in particular, I saw the Eric Voorhees, Peter Schiff debate on Bitcoin versus the dollar. Then I saw debates on Bitcoin versus gold. Then I saw the Andreas Antonopoulos speeches on Bitcoin and the Internet of Value. I read the Bitcoin Standard. I read The Bullish Case for Bitcoin by Boyapati. I read a number of research papers on it. There's good work done by John Pfeffer, by Lynn Alden. I would say after about 3 to 5 hours of YouTubing and reading the basic papers, you kind of get the gist of it. But if you read the books and you spend more time, somewhere between 50 and 100 hours, it kind of clicks in. And so that's kind of what I did.
Yeah. And I think skeptics that I know always say the same thing, like blockchain is real, but Bitcoin is like a scam or whatever. You can't hold it. You can't touch it. They say the government's going to take it away or the internet's going to shut down or it might get hacked. Maybe comment on the skeptics and kind of those main arguments.
Well, I think the acid test is, did the skeptic spend 100 hours reading the Bitcoin Standard and reading the Bullish Case for Bitcoin and reading the history of money, and did they play with it? And for the most part, the answer is no. It's very easy to be skeptical in the first hour. People are also skeptical of fire. Parents say to their kids, don't play with fire. Yeah, but by the way, teaching your kids don't play with fire, fire is what separates us from the apes. The only reason we're human is because we play with fire, And then if you look at the same skeptics about electricity, if you read the history of response to the Copernican revolution, to what Galileo said, if you read what they said about Harvey's theory of the heart and circulating blood, if you read what people thought about internal combustion engines, if you read what they thought about aircraft flight, if you read what they said about radiation, nuclear power, and genetics, you're just reminded, what Max Planck said, which is science advances one funeral at a time. And Harvey said, no doctor over the age of 40 will ever acknowledge that the heart pumps blood.
Yeah.
So this is not a new idea. People that are senior, that are wealthy, that are intelligent, that are accomplished, don't have a need to embrace a new paradigm, and so they don't. When Led Zeppelin came along, they came along a couple of years after amplifiers, electric guitars. There were very accomplished musicians at Carnegie Hall playing the oboe, directing the orchestra, that were acknowledged as musical geniuses. Just because you're a genius and successful and universally loved doesn't mean that you're going to pick up the guitar and be a rock and roll great. And while those guys were actually creating all that iconic music, the older generation was said, rock and roll, that's the devil's thing.
Burn it. Burn the records.
That's going to ruin, it's going to ruin us. And so the pushback to new technology, it's new ideas based on new technology, is as old probably as Prometheus, right? The entire history. You come up with fire, and what do? They strap you to a rock, and and they peck away at your liver for all of eternity, right? But at the end of the day, humanity is what it is because we harnessed chemical energy and nuclear energy and kinetic energy and potential energy, et cetera. So this is just a new form of energy that the old generation is afraid of, doesn't understand, doesn't need, and reflexively push back on.
Another main pushback that I always hear is kind of like the government's going to shut it down. Now, we obviously had a red wave with the election in early November, but kind of when you think about it and some of the arguments that you've laid out, don't you think we've kind of reached escape velocity here where some governments are kind of embracing it already, but once one of the big ones do, it's almost everyone has to be all in. Like, why would you ever shut it down, right?
I think that in 2020, there were people that didn't understand it and said it's tulip bulbs, and they rejected it, and that was the deniers. But the skeptics were like, well, it's a good thing. It's digital capital. I get it. It's actually the best form of money ever created. It's actually so good that my argument is the government will take it away from you. Yeah. And so that was the next maddening, not the denier, but the skeptic narrative of, yes, you're totally right. It's just too good. That's why nobody will allow you to have it. I'm like, I have a pocket thermonuclear reactor that gives me infinite energy and power for all of eternity. And the answer of the skeptics is, well, we're going to have to stop that. That's threatening to us. And so that was an argument in 2020. But the next 4 years, you saw Gary Gensler, Janet Yellen, Jerome Powell, Christina Lagarde all acknowledge that this is a digital asset, and it should have been apparent to anybody reading the congressional testimony and paying attention to what people were saying that, in fact, Bitcoin is the greatest innovation in the history of finance. And it's not getting taken away from you. It was not banned in Russia or China or the US during that period. You just had a lot of FUD. And when the Chinese, say, implemented capital controls, or when they clamped down on Bitcoin mining, that became a, well, Bitcoin's getting banned in China narrative. But it was never true then. And people that spend 1 hour focused on it wouldn't dig into the 2 hours to realize that all of their fears and all of their criticisms aren't even true. They're just uninformed. But now we get to 2024. And in 2024, that was dying off. The skepticism was fed by the crypto winter, the crash of FTX and the like. And so people had a field day with that. But in January of 2024, the SEC approved Bitcoin spot ETFs, and IBIT and FBTC got approved. And if you were paying attention, you would have noticed in short order, those became the most successful ETFs in the history of the world. You would think that would be a clue. What followed, that maybe the government's not going to ban it? When you get 42 ETFs that hold collectively now $100 billion of assets, that might be a clue that maybe they're not going to ban it. What happened next was the Republican and the Trump embrace of crypto and Bitcoin. That was your second clue. The third clue was the extraordinary growth of MicroStrategy I mean, in this time frame, we literally had gone from $1 billion company to a $50 billion company. Might have been a clue. Then you actually had the announcement that MicroStrategy was going to raise $42 billion to buy Bitcoin, and our stock traded up.
Especially with the ATM being a big component of it.
We announced the largest ATM in the history of the world, again, and we did something that had never been done before. We announced a $21 billion equity issuance, and the stock traded up. By the way, the simple clue is the capital markets think A, it's a legitimate asset, and B, they think it has a higher return than the cost of capital, which is the S&P index. So a week after that, you had the November 5th elections, and you had a red wave sweep, and the Republicans won the Senate, the House, and the White House. And now you have a pro-Bitcoin head of Treasury, head of SEC, a pro-Bitcoin president, a pro-Bitcoin Senate, a pro-Bitcoin House, right, of representatives. And then MicroStrategy had raised $10 billion between August of 2020 and October of 2024. A $1 billion company raises $10 billion for Bitcoin. That's a little bit of a clue. But then we raised $15 billion in the next 4 weeks. And that might have been a bigger clue. Now you're ending the year, and what you have is 60 companies that hold Bitcoin on their balance sheet that are in the public capital markets, probably another 60 ETF-like instruments. You have Bitcoin ETFs popping up everywhere in the world. You have Jerome Powell saying it's not a competitor to the dollar, it's a capital asset, it's a competitor to gold, right? Which has been obvious to everybody in the institutional ecosystem for 4 years. But if you actually reframe the narrative from it's digital currency and it competes with the dollar, the government will ban it, to it's digital capital, it competes with gold, real estate, equity portfolios, and collectibles as a store of value. Well, then, then the government's not going to ban it. The government's going to let you buy it like anything else. So Jerome Powell said that about a week ago. And so now you have an awareness, between his words and Vladimir Putin saying, who can stop Bitcoin? Nobody. And the Chinese revving up the Bitcoin machine again, and the spread of Bitcoin everywhere. Now, all of a sudden, the deniers, are discredited, and the skeptics are now falling out of consensus. You're just looking uninformed and ignorant and foolish if you're a skeptic. And now we move into the stage of traders, investors, and maximalists.
I always kind of felt that people that I talk to, and it's not a surprise, they view it kind of just through the American lens. And when you think about the global nature of Bitcoin and people in like companies where their currency is like a train wreck, people are like, oh, we'll put it into US dollars, but like they may not be able to do that.
Yeah, I think it's an important point. There's the flat earthers, and they think that the universe revolves around the earth. And that's what the USD maximalists are. If you just imagine a financial world of the US dollar, okay, well, the US dollar is your capital asset. What's the volatility of the dollar against the dollar? 0. What's the return of the dollar against the dollar? 0. It's a 0-0 frame of reference. The universe revolves around you. Now along comes someone that says, you know what? We're going around the sun, okay? And we're moving pretty fast around the sun. And then they had this twist. The Earth's spinning 25,000 miles an hour too. Did you know that? Okay, so now we're orbiting the sun and the Earth is spinning. And so that is Bitcoin. Bitcoin is 60 velocity, 60 ARR through US dollar space. It is spinning 60 volatility against US dollar space. There's energy in those things. There is rotational energy. There is velocity. If you're a real physicist, you're like, and by the way, the sun is moving through the universe, right? We're spinning on our axis. We're orbiting around the sun. The sun is orbiting around the center of the Milky Way. Maybe the Milky Way is moving. And it's a frame of reference within a frame of reference within a frame of reference within a frame of reference. That is humility, okay? So if I take your 40-ton weight, like $40 billion, and if I put it on your balance sheet in dollars, it's like a 40-ton sculpture. It's a paperweight. If I take the same 40 tons and I fashion a flywheel, and I put it on the back of a train moving 60 miles an hour, and then I spin the flywheel 60 RPM, and you think about that image, if you're an engineer, there's energy in that, right? A train moving 60 miles an hour with a 40-ton flywheel spinning 60 RPM has a lot more energy than the bronze statue in your backyard. So when you're a US dollar conventional financier, you just see $40 billion and you think, well, that's just a liability. By the way, it is a liability because it's generating minus 15% against the cost of capital, which is the S&P index. So one of them is minus 15%. I might as well take the 40-ton weight and throw it on top of a swimmer and chain it to your neck, and it takes you to the bottom of the ocean. And the other one is plus 45% cost of capital. That one, right, is like a nuclear reactor, helichopper, right? Or one of those choppers in the Avengers, and that's pulling you up, with enormous force, and then it's a gyro and it's spinning. And if you're a financial engineer and you can see the difference between the two frames of reference, it's not that hard to figure out how to arbitrage the two frames of reference. An engineer walks past a fire and they put it into an engine. They put the engine into a horseless carriage. They create the automobile, and that's Henry Ford. An engineer walks past a mountain lake with 500 trillion gallons of water. It's up 5,000 feet. They build a dam. They put a turbine on it. They move 1 billion gallons of water through a 60-foot drop ahead. And then they spin the turbine, capture the electricity, light up a city. Right? That's the engineering think. And then the normie looks at the mountain lake and it's like, oh, I could swim in it, but it's cold. And the normie looks at the fire like, well, that's going to burn me. I'm going to run from that. And so you're either a tourist and you swim in the lake, take a selfie, or you run from the fire, or cook s'mores on the fire, or you're an engineer and you basically light up the city, or you create the automobile industry. And so if you're a financial engineer and you understand economic physics and you think about monetary physics, and you're humble enough to realize that maybe the world, the universe doesn't revolve around you, maybe it's possible that there are energy sources in the universe beyond your little backyard, then you might be able to actually create a rocket or a plane or a train.
As a digital capital or a corporate finance tool, and a lot of people who listen to this are kind of in the finance industry, but I think what's kind of so interesting about the concept of Bitcoin on the balance sheet is it kind of disrupts the traditional valuation methodologies that people have been talking about for 100 years, whether it's PE or enterprise value to EBITDA, right? It's shifting it a little bit from the P&L, which is important, obviously, but to also a balance sheet that can really create value over and above what some of these big companies are doing right now, where they sit around with like 20 or 30 or 40, 50 billion in cash and treasuries. So like, how do you think about like kind of the valuation of companies from kind of the P&L and expected earnings to the P&L and expected earnings plus a balance sheet with Bitcoin on it?
If you reason from first principles, it's like solving the homogeneous differential equation versus the particular differential equation. When you're just are spoon-fed what to think by someone else that came before you, then you go, oh yeah, well, what's the earnings of the company? What's the growth rate? I'll multiply it times the multiple, and that's what the company's worth. That's a particular solution. The homogeneous solution is, well, what's the value of the assets of the company? And then what is the company's ability to create value in a given period and over time, right? So I give you Central Park. What if I offered you all of Central Park right now? It's got no cash flows. Is it therefore worthless? By the way, I give you Central Park and I give you an unfettered right to develop it any way you want. You can build 100-story buildings on every block. The point is, I give you a property right The value of the property is equal to the optionality of the property and the right that I convey to you. So when I go to a company like Microsoft, it's like, well, 95% of Microsoft is valued based upon a multiple of forward expectations. It's like Microsoft makes whatever, 10 billion a quarter or 25 billion a quarter. I might take your quarterly results, multiply it by 150. And if you make $1 billion a quarter, your company's worth $150 billion. Okay, and then what about your assets? What property they own? Would they be more valuable if they owned all of San Francisco? Yeah, I mean, maybe, but the SEC 40 Act, it's a very constraining act because it prevents operating companies from holding more than 40% of their liquid assets in securities. You have to have property or commodities. The Treasury bill got a carve out. You can hold U.S. Treasury securities because you got a waiver from the government. The government advantages itself. But otherwise, what that means in effect is you're going to have to own soybeans or gold or property or Bitcoin or cash. The result of that is 99.9% of all operating companies, their liquid treasury asset is treasuries or cash. They don't want to hold illiquid assets. Real estate has a positive return, but it's non-fungible, right? It's illiquid, and so it's fairly difficult to handle. It's not portable either. So I don't want to hold that. I don't want to hold gold. Gold is a little bit more liquid, a little bit more fungible, but the problem with it is all of these things, gold, real estate, soybeans, silver, timber, natural gas, oil, they all tend to be lower performance, less volatile than the S&P index. So if you're a public company, what you would do with your cash flows is you would either give it back to the shareholders in a dividend and let them invest in the S&P, or you would buy your own stock back, or you would buy treasury bills. And so less than 5% of the valuation of Microsoft is based on assets. 95% is based on expectations. That actually means operating companies are the most highly levered, most risky holdings in the world. And the irony is conventional B-school wisdom would tell you that the responsible thing to do is strip the volatility off the balance sheet by surrendering assets and surrendering capital, and then strip the volatility off the P&L by converting your business into a real estate business. You basically want to sign all your customers to 3 to 10-year contracts with price escalators. And if you strip the volatility from both the P&L and the balance sheet, and if you surrender all your capital, then you will be valued exclusively on forward expectations on a razor-thin capital foundation. What that does is it means you have to force your customers into a straitjacketed relationship they don't like. You have to bundle products, which is going to inflame and enrage your competitors. And you're going to flag yourself to the regulators as a potential monopoly, because when everybody needs it and you have to sign a 3-year contract and take price escalators to buy it, you start to look like the power company and the water company, and eventually you end up with a public, rating agency that controls your pricing. So that's conventional wisdom. It also means it cuts your enterprise value in half. If you actually embrace digital capital returns anywhere from 2 to 3 to 4 times the cost of capital. Bitcoin is up 60% a year when the S&P is up 15% a year. And so if I can return more than the S&P, I could eliminate the bonds, I could eliminate the dividends, I could eliminate the buybacks, and I could also cease with the dilutive mergers and acquisitions. 95% of all M&A activity is dilutive. Dividends are dilutive. Buybacks, what they do is they allow you to maybe slightly outperform what you would have otherwise done. If your company's growing 7%, you can goose it to 10% with a buyback. If your company is returning the S&P result of 15%, you can get to 18%, which is what Microsoft did with a buyback. But the price you pay is fragility. You're basically levering up the company So that as soon as a regulator, like say China decides NVIDIA may be a monopoly, or the EU decides to hit a big tech company with a tax, or there's an FTC investigation into a big tech company. As soon as you end up with regulatory uncertainty or a competitive development, your stock's going to crash. And here's the big idea, Tom. No one that had a choice would ever willingly submit themselves to that regime. There's a Stockholm syndrome here. CFOs and CEOs of public companies somehow think that's best practice. That is railroaded practice. That is the worst possible practice. There's no intelligent investor on earth that would subject themselves to that practice. For example, look at the Harvard endowment or the Yale endowment or the Mormon endowment or any endowment of any 501c3 on earth, the Gates Foundation. They're not valued based on forward expectations of earnings. Every one of them has massive portfolios of property, real estate, equity, securities, collectibles, etc. Now look at the portfolio of every rich person on earth. Take the top 1,000 wealthiest families. What percentage of their portfolio is cash equivalents? Not even 1%. Jeff Bezos, Elon Musk, Bernard Arnault, he's not valued based upon a forward multiple of his earnings. He's valued based upon his holdings in LVMH or the like. If you own a property business, if you own art, if you own buildings, if you own equity in an operating business, if you own the S&P index, you could very well take the position that every year on January 1st, if you do nothing, you're going to be 7 to 10% richer by the end of the year. If, on the other hand, you own a restaurant or a dental practice, if you were to grow your revenues 10%, it's not clear that you would keep up after tax. And so everybody in an operating business is on a treadmill. They have to run 10 to 15% harder every year to stand still. Everybody owning capital assets is going to be 10 to 15% nominally richer at the end of the year doing nothing. And so the deck is stacked in favor of institutions, endowments, and high net worth individuals and free investors, and it's stacked against regulated entities. The second worst is a regulated public operating company that can't hold securities. And the first worst is a bank, because a bank, is even more tightly regulated. Over the last 4 years, the single worst capital asset you could hold is bonds, and all banks have to hold them. And the single best asset is Bitcoin. And the real revolution here is that in the year 2024, for the first time in 100 years, and the first time since 1940, the 40 SEC Act, an operating company has a capital asset which is liquid and fungible and global that actually performs better than the S&P index that's accretive, and that you can hold 100% of your treasury assets in. And that was year zero. 2024 is year zero. And year one of the modern era of digital capital is 2025. Because in 2025, you have fair value accounting, which is mandatory, which fixes the accounting confusion. You have a supportive head of the SEC, a supportive head of the White House, a supportive Congress, a supportive head of the CFTC, right? You have a supportive Wall Street, and you have a whole set of Bitcoin standard companies. So you actually see people are plugging their balance sheets into digital capital. And it's really like putting a nuclear reactor in the middle of your factory and replacing a wood-burning stove. And yeah, a lot of people are afraid of it. But I'll make one last point, Tom, which is, if everybody knew what I knew, and if everybody had done 1,000 hours of research, and if Bitcoin wasn't volatile, and instead of going up and down and being a volatile 60%, if it was just a straight line, perfect exponential 60%, everybody in the world who you hate, who has more money than you, who's more arrogant than you, would basically own all the Bitcoin. It would be $10 million a coin, and you couldn't have any. You're getting a 99% discount to do the work and endure the volatility. And if you want it to be easy, you're going to pay 100x more. And so you just wait until there is no controversy, and then you're going to pay 10 million a coin. Yeah, and you're still going to buy it because it's still going to go up 15% a year.
Yeah.
But you're not going to get rich off of it. You're just going to have to buy it in order to keep your money.
Michael's message is pretty clear. Bitcoin is the currency of the future, and the ship is leaving the port. We can now board or wait for calmer seas, but those willing to weather the storm, embrace its volatility, and understand its potential will be the ones to reap the biggest rewards. Of course, there are a lot of factors that could affect the speed of that journey, and I asked Michael what political developments or regulation changes would have the biggest impact on Bitcoin's trajectory in 2025.
I think the adoption of a digital capital policy by the United States, if the U.S. creates a strategic Bitcoin reserve, if they put in some rules like we're not going to sell our Bitcoin, Donald Trump said never sell your Bitcoin. If the U.S. government says we're not going to sell our Bitcoin anymore, right, that will elevate it as digital capital. That makes it superior to every other asset in the world, right? The only things the U.S. government doesn't sell are their national parks, their nuclear stockpiles.
Yeah.
Right?
Yeah.
So that would be a big deal. And the progressive purchase of it would be a huge deal. If the U.S. actually starts to acquire Bitcoin, right, then the U.S. is going to own and dominate the world reserve capital network. Bitcoin's going to go to $100 trillion, then hundreds of trillions. The U.S. will make $50 to $100 trillion off of it. They will demonetize every other capital network. All the money in the world, all the global money will flow into the U.S. All of our enemies' money will flow into the U.S. All the capital from the 20th century will flow into the 21st century. So I think the adoption of Bitcoin as a capital asset would be a major game changer. I think the second game changer is a digital assets framework in general. If the U.S. government embraces digital currency in the form of stablecoins and Tether relocates to the United States, the stablecoin industry would go from 150 billion to $1 trillion to 10 trillion. That will spread the U.S. dollar as the world's reserve currency on 8 billion Android phones and iPhones.
I was going to interrupt you for a second, Michael, because I don't understand the political process, but I do know there's like a razor-thin margin in Congress, I think 2 seats. Do you think they can get some of this through Congress with that razor-thin margin? What's your instinct on that?
Well, I think a digital assets framework is a very popular thing. I mean, what American wouldn't want the U.S. dollar to be sitting on 8 billion phones? And why wouldn't you want the U.S. dollar to be the currency that 8 billion people use? The spread of digital assets framework is good for America. It's good for the dollar. It's good for innovation. I haven't really heard any cogent argument for why we don't want America to be the technology leader, the economic leader, the finance leader, the spiritual leader, the ideological leader of the world. And the way you're going to do it is technology. And so the digital assets framework is about revitalizing the capital markets. It's about revitalizing the digital economy. It's about spreading American values to the four corners of the earth. And right now it's impaired because we have a crippling anti-innovation framework. That all changed November 5th. Now there's every indication that we're going to get digital capital. The U.S. has been hostile to digital assets, and that's been slowing things down. You know, Tom, let's make sure everybody understands the stakes here. When the SEC 33 Act and the SEC 40 Act were put in place, the agenda was to create a cartel in restraint of trade to block most of the people in the market from accessing the capital markets. It was a centralization of the capital markets to D.C. And originally, the entire 33 Act was about undermining the J.P. Morgan interest in New York because the Rockefeller interest would be dominant. Okay, so Those acts were political, and the result was they limited access to the capital markets to big, rich companies that were wired into the political ecosystem. That has progressively gotten worse. So today we have 4,000 publicly traded companies, and the cost of compliance is more than $10 million a year. The cost to take a company public might be $40 million a year. Okay, and we had 10,000 public companies 20 years ago, and now it's 4,000. So what you have is you have 0.06% of the businesses in the United States that can access the capital markets. Once again, this is Stockholm Syndrome. You're somehow expected to think that capital is not for you, right? This is not, you don't want to be able to raise money quickly and easily. That's for other people. You don't need money. Well, why isn't it for me? Why is it that, 4,000 companies get access to money and the other 400 million companies don't? The answer is there's no particular reason you shouldn't be able to, other than a crushing, overburdening regulatory apparatus, crushing the life force out of 99.99% of all business ventures.
Yeah.
Okay, so the real stakes here are a digital assets framework that lets you raise capital where the compliance cost is 10 basis points of the money at risk. We ought to have a cost of compliance that is proportional to the value at risk. And it seems like if you had that framework and you combined it with an admonition, don't lie, cheat, and steal. And if you lie, cheat, and steal, you're liable for your lying, cheating, and stealing on a civil or criminal basis. And they ought to just stop there. And if you did that, then that would mean that 1 million celebrities could issue a token. 10 million small businesses could issue a digital security or a digital token. You could have an exchange that trades the 10 million things, and you could self-custody the 10 million things. And now the capital markets become competitive, and people ought to be able to choose between whether they want to invest in 22 restaurants in Miami or whether they want to buy a share of Apple. But right now the deck is stacked in favor of Apple against the 22 restaurants in Miami. And there's no ethical reason. There's no technical reason. The crypto community understands that. The existing administration has just been very regressive. It's got to change. And so what do I expect? The most auspicious thing is you've now got a pro-innovation cabinet. You've got pro-innovation in the House and the Senate. And there's a lot of technical solutions to do things 1 million times faster, 1 million times smarter, 1 million times cheaper. Will it happen? Well, look, there's politics and there's going to be political forces. Maybe the antiquated oligopoly may not want it to happen that fast. But I am more optimistic today than I was on November 4th or at any point in the past 20 or 30 years. So I'm looking forward to seeing what happens, but there's obviously a bit of uncertainty, Tom, about how this all plays out.
So I just have one last question, and I read the Bitcoin Standard last month, and one thing that is such a big idea is that societies built on sound money really thrive and have thrived over the centuries, and there are examples of that with progress and innovation and invention and the arts even, and war and peace. Maybe comment on that, because it's such like a huge idea.
You've got a biological metaphor. A type 1 diabetic can't form fat cells, can't store organic energy. I can feed you 20,000 calories a day and you'll starve to death if you're a type 1 diabetic. And so the ability to store energy is critical to life. The equivalent of a diabetic in an economic system is a country suffering from hyperinflation, like the Weimar Republic, like you see in certain African nations, like you see in Venezuela. When the currency no longer is a store of value, then your economic life expectancy is a matter of days or weeks, and you're ripped back to Stone Age barter. Being ripped back to Stone Age barter is like saying you have to just continuously eat, right? And if you stop, you die. There is no battery. So one extreme is literally Stone Age barter. I have arrowheads and stones and glass beads and bales of tobaccos and giant stone coins of the Yap people. And then those are all bad. And I go to copper tokens and they get replaced by silver, and silver tokens get replaced by gold, and gold tokens get replaced by gold coins, and gold coins you can clip get replaced by gold coins you can't clip. Right? And they just keep moving up. If you inflate the gold supply 2.5% a year, then that means every 35 years, your gold value is cut in half. So the half-life of capital in gold is 35 years. If you're creating 10% inflation, the half-life of the money is 7 years. When you get to 70% inflation, the half-life of the money is like 1 year. When you get to 0% inflation, the half-life of the money is forever. Bitcoin is the first digital capital asset. It's the first commodity money that's digital, where the commodity is capped at 21 million. And so the significance of Bitcoin is you've created the first perfect money because it lasts forever. And the limit from now to infinity, the inflation is nothing. And in the limit from now to infinity for gold, it's 2.5% or more because there's uncertainty. And in the limit from now to infinity for every fiat currency, it's infinity, right? And so I could say in the history of money, it represents the inflection point where you finally got non-inflating money. Every other commodity money was an imperfect, inadequate representation. If you read the history of science, the way they discovered longitude was they had to create a perfect clock. And John Harrison created a perfect clock to create perfect time. And so in order to create a clock which does not gain or lose time, they needed a material which would not expand and contract, because under heat and under humidity, all materials expand and contract, and that screws up the clockwork. And Harrison had the brilliant idea of overlay the material so that the one that's contracting is offsetting the one that's expanding by the same amount, such that their imperfection became perfection. He created a perfect mechanism, and we could keep perfect time. And when we knew the time, we knew where we were. And when we knew where we were, the British ruled the oceans, and it created an empire. Bitcoin is perfect money. You now actually have the ability to do perfect economic calculations in time and space for a capital asset. By the way, Parliament offered like £10,000 to anybody that could solve the problem of longitude on the ocean. And every learned professor from Cambridge and Oxford, they all joined the competition, and they tried to use higher levels math and physics. They all failed. And this clockmaker without a degree, he was the Satoshi of time and space. He solved the problem, and everybody in the establishment rejected his solution for 30 years. They rejected it because he just wasn't legitimate and elite enough. And so Satoshi is the Prometheus, is the John Harrison, is the Wright brothers. It's like two guys that make bicycles figured out how to fly. It wasn't a professor of physics from Harvard or MIT. And so what you have in digital capital is you have a creation that the establishment doesn't need, doesn't want, is threatened by. But there's another group of people that embrace new ideas. And if you're a millennial and you want it and you need it, or you live in the third world and you think this is the difference between life and death for me, paradigm shifts come because the old guard dies or because of a war. So when you're about to starve to death or someone's about to kill you, at that point, you pick up the new thing and you open your mind because you have a need to know. And this is spreading on a need-to-know basis everywhere in the world. Or in the words of William Gibson, the future's already here, it's just not evenly distributed.
If the conversation in 2024 was focused on the digitization of information, in other words, AI, with the new administration, it looks like that conversation will shift to the digitization of capital this year. And as we heard from Michael, Bitcoin has the potential, at least in theory, to revolutionize traditional economic systems on a global scale. I expect Michael and MicroStrategy will continue to be outspoken champions of this transformation, playing a pivotal role in our understanding of the future of digital capital. At Welcome to the Arena from ICR, we're working really hard to bring you exciting guests and great content. If you found this episode insightful, please subscribe to the show on your podcast app and leave us a 5-star rating. The more the show grows, the more interesting voices we can have on the podcast, and in turn, that should demystify a lot of the stakeholders around public companies and soon-to-be public companies. Thank you so much for listening. Thank you to Michael Saylor for joining us today. This was an absolutely fascinating conversation. Cannot tell you how much I appreciate it. I look forward to hearing more from Michael at our conference in Orlando next month, and I'll be keeping a close eye on how it all plays out for Bitcoin and MicroStrategy over the next 10 years. This is Tom Ryan, and we'll see you next time back in the arena.
References to specific stocks are not intended to be recommendations for specific trading behavior. Comments presented on this podcast are intended for informational and educational purposes only, and do not represent opinions or recommendations on whether to buy, sell, or hold shares of a particular stock. All investors are advised to conduct their own independent research into individual stocks before making a trading decision. In addition, investors are advised that past stock performance is no guarantee of future price performance.